Most people don't lose money in the stock market by accident. The system is designed to take it. I'm going to show you the mechanics of wealth transfer, the reality behind the easy money lie, and the one specific error that ends more careers than any market crash, mistaking a lucky start for a repeatable strategy. We are sold a very specific fantasy about trading: the laptop on the beach, the absolute freedom from the daily grind, the effortless daily profits. It's marketed as the ultimate escape. But behind those success stories is a silent majority, a massive, invisible wave of beginners who bought into that exact dream, lost their savings in months, and vanished without a trace. The public perception of the market is a manufactured storefront, built to hide a staggering failure rate and keep a constant stream of fresh capital entering the system. The cycle begins with a small, cautious investment. You put just a few $100s into a popular ticker, and almost instantly, you're in the green. You start mapping out an early retirement, convinced that you've suddenly gained an intuitive sense for the pulse of global finance. It feels like you've seen a pattern everyone else missed. That specific moment of confidence, when you believe the market is easy, is exactly when the trap is set. Amateurs completely misread those early profits. That win isn't a validation of your talent, it's bait. On one side, a retail investor. On the other, institutions with terabytes of data, instant execution, and massive capital. They use their weight to buy at the bottom, building the trend. When you buy at the peak, you are simply their exit liquidity. In this environment, beginners are playing a mathematically rigged game. You are participating in a system where you are the product, not the player. While institutional speed is a threat, your own internal biology is what actually executes the liquidation of your account. Every trade you make is driven by three primitive impulses: the fear of missing the next big run, the greed for a higher return, and the total inability to sit still. When a position drops, you hold on, hoping it recovers. When a position rises, you panic and sell immediately, terrified the profit will disappear. You are reacting to feelings, not to the market. This reliance on emotion makes your behavior incredibly easy to forecast. You stop being a strategic actor and become a predictable data point for an algorithm to exploit. The market doesn't need to defeat you. It simply waits for your own human nature to take over and exhaust your capital. Ask yourself, if making money here were as simple as following a few social media gurus, why does nearly everyone fail? The market doesn't create wealth, it reallocates it. As this model shows, the stock exchange is a precise transfer engine, moving money away from the impatient and emotional and delivering it directly to the disciplined. The system ignores intelligence. Instead, it rewards slow, boring growth and consistency. It punishes the very things amateurs crave: excitement, luck, and instant results. That deep-seated desire for a fast payout is the blinder that ruins your critical thinking. It ensures the wealth transfer continues, moving from your hands to theirs. Look at this flow of data. The market is completely indifferent to your goals, your struggles, or how much you need a win. It responds only to your behavior. You can continue relying on emotional shortcuts and become another statistic. Or you can learn to control your impulses and play the long game like a professional. We started this by talking about the error of mistaking a lucky start for a repeatable strategy. Survival in the market isn't about finding a secret. It's about the endurance required to stick to a plan when your emotions are telling you to run. In the next video, I'll show you the exact steps beginners can take to move past luck and start building a real systematic edge. Make sure you're subscribed for that one.